Hey guys, Killstokes here. Welcome back to another Weekend Trading Edge video, your weekly look around the markets where I share with you the best trading ideas that are on my radar for the week ahead. We've got 10 fresh trading opportunities from all different types of markets to look at today. So yeah, you might want to grab that coffee because this one could get long. Oh, and also make sure you stick around to the end because I'm going to answer a special request that one of you made about building a trading strategy using channels. Now, before we dive in, make sure you hit that like button and subscribe if you're new. That way you don't miss this weekly video and all of the cool videos that I sprinkle on this channel throughout the week. So we're gonna start with the euro dollar, but the chart you're looking at right now is silver because I'm gonna give you just a very brief recap of what happened this week. Gold and silver fell off a cliff. Gold dipped by about 10%, as you can see right here. Silver dipped by about 30%, as you can see right there. I'm not going to touch on those yet because I don't have any clear options, and I don't like telling you stuff just to tell you stuff, but perhaps we'll revisit this during the week if we do get some counter trend opportunities available. A lot of what happens with these metals also depend on what's happening outside of the market on the fundamental side. Speaking of the fundamental side, we saw a pretty significant dip in the euro dollar, which means strength in the US dollar to end the week. And this was mainly probably due to the announcement of our new Fed chair, our new Fed chair, Warsh. He is secretly expected to be hawkish, which means good for dollar. Hawkish typically means you're in favor of higher rates, despite him saying kind of otherwise publicly. And I think the market saw a big reaction off of that. Now, with that being said, we ended last week with a bang and a warning of expected gaps, which we saw in the markets. We've pretty much come right back to those gapped areas right here. And I will give you another warning because there is still a lot going on, especially with President Trump threatening to strike Iran and stuff like that, that we may see more volatility on the open of this week. And don't forget, this week is the first week of a new month, which means we have our non-farms jobs number coming out as well. So we may see more volatility at the end of the week as well. Volatile times in the market. But our job here is to break down potential trading opportunities, and here's what I have on the radar for the euro dollar. As we go down to the 4-hour chart, again, you can see we pretty much came to the same level that we gapped at last week. We gapped up for the open. We did a little sideways shuffle here before shooting up throughout the middle of the week. We've come right back to that area here. Now, for some of you, you may be seeing a potential advanced pattern here, looking at this as being a swing low to swing high, X to A to B, B to C, C to D right there. Two things about this. One, this wouldn't be a starting point for me. I know whenever you get a gap in the market, it looks a little bit weird visually, but how my mind envisions these gaps is I just look for a missing candle. So I would imagine this being I can't draw it right in the middle, but this would be pretty much a green candle that goes straight up right here. So it's not necessarily a starting point for an X to A for me. More importantly, right, we spoke about rules during the week. I showed you guys the very embarrassing photo of one of my first trading desks where I actually had the rules printed out on the wall behind me so I can follow them. One of the things that we have to understand with trading in general, but specifically patterns, is that if we follow our rules, we have a built-in checklist for if a setup is legit or valid or if a setup is invalid. So let's say you were a trader looking at this as an X to A. Well, step one is identify our X to A. Step two is bring out a Fibonacci and see what level our B leg hits. Our B leg would be this first retracement right here. If our B leg hits a 618, I know that I'm on alert for a potential Gartley pattern. All right, check that off. Next, for the Gartley pattern, I need to measure my C leg, which is right here. I know that my C leg must also come to a 618 Fibonacci retracement. So I take my Fibonacci retracement tool from the swing high of my A down to the low of my B, and I ask myself, does the C leg hit the 618? And this is as black or white as it can be. It does not. So I never get past that section of my checklist. Right away, this is an invalid Gartley. There's no need to continue. There's no ifs, ands, or buts. It's done. I erase it. I tear up whatever I need to tear up. I tear up my charts, but you don't want to do that. You'd break a computer. and you move on to the next opportunity. So this is why it's important to have a rules-based systematic style of trading. That way you have as many obstacles in the way of you making mistakes and doing dumb trades as possible. So no Gartley here. I want to sprinkle that lesson in here just to make the video even longer. But something I am looking for is a potential continuation lower. Now, what I would like to see first is this. I would like to see us take out these lows. We spoke in the podcast the other day about tweezer bottoms. Here's a good example of tweezer bottoms right here. I would like to take out those lows right below 18.5. And if we can take out those lows, my expectation would be that we travel back down to this level. So this is the predictive level that I'm making. What this is going to do is this is going to offer a tradable opportunity from this area right here, 1836, all the way down to this area right here, about 1769. And again, it could be a little bit more if we do get a retracement. So putting this in a rules-based format, if price action violates these lows, and this is just my personal trading style, so this doesn't have to be your rules, right? Again, we mentioned this in the podcast the other day. I'm going to keep mentioning podcasts because I do 3 podcasts a week, and many of the subjects overlap on each other. And although I assume you're listening and watching them, you need to if you're not, because there's so many gems sprinkled in there. But one of the podcasts we spoke about was the difference between just following a trader's rules, right, blindly, not knowing why or why they're doing it, just knowing what they're doing it, versus really understanding it and creating your own rules. And how the cool part about trading is that we have the flexibility to do whatever we want. So my personal rules as being a pullback trader would be, if price action breaks and closes below this level, then look for pullback. If we get pullback, then look for reason for entry. If we get reason for entry, then get short, and we can look for a move down to that area right there. Now, why did I choose that area? Why did I choose? There we go, words. Well, one, it's a previous level of structure, right? We got structure highs right here. Boom, you can see market came up, came to a standstill and kind of just went sideways, retraced a little bit, but hit this level multiple times. We have a little bit of an elephant candle right here as well. An elephant candle is going to be this this strong bullish candle right here, and the consolidative point before that. We might have a Fibonacci. It might be a 618. You guys that know the video, I'm doing this for the first time here as far as drawing on the analysis. So I think we're going to be at a 618. Make me look good, baby. Yeah, there we go. 618 right at the top of that level. And then lastly, I know you guys that are in the live room with me, you're shouting it. Where's the volume? Where's the volume? Well, let's pump up the volume. Let's put some volume on our chart. Boom. And you can see we have a nice area of high volume spikes right here. If you guys are new with volume, this is the anchored volume profile tool that I'm using. There is a video that I will link at the end or below that shows you exactly how to use it. But I look at volume as being synonymous with interest, meaning the more volume there is in an area, the more interest there is in an area, the more interest there is in an area, the more price is attracted to go to that area. So you can see volume spiking out right here. You can see volume spiking out right here. Our point of change is a little bit lower right at the end of this zone. That's this white line. And then in the middle here, we have what I call the void, right? And the void is, think about it like a highway with no cars on it. So price should be able to travel smoothly through that level. So essentially what this is doing is this is opening up the door for a nice bearish continuation opportunity if, right, it all starts because we're following our rules, if we can get that lower low, lower close to start with. Next up is going to be the dollar yen. And this is another avoidable situation. No, I was trying to be cute with words and use the word void because of the volume and avoidable. But avoidable means you wouldn't want to trade it. So this would be one you want to trade. Anyway, that was bad. This is why I trade and I don't crack jokes. But we have two things setting up here on dollar yen. One has already been triggered, right? So we have a Gartley pattern here. If I measure this out, we have our starting point right here, our swing high to swing low. That is going to be our X leg to our A leg. Once again, we want to take our Fibonacci retracement tool out, drag it from the swing high of our X to the swing low of our A, and we want to see what Fibonacci retracement that comes to. It comes to a 618, which means I'm on Gartley alert. Just like last time, I then want to take my Fibonacci retracement tool and drag it from the low of my A to the high of my B right here. And I need a 618 to be hit. This time it does get hit, and my Gartley completion is going to be at the 127 extension, right? So Fibonacci extension tool from my A leg, the low of that, to my B leg, the high of that, and back down. And you can see right here is going to be my D completion. As we put that all together, and I give you some nice little letters to look at, that gives us a X to A to B, B to C. You can see this on a lower time frame as well. I just want to stick here for the next example. B to C and a C to D right here. Now, we have not violated the X leg, so this is still a valid pattern. This is a pattern that I am in, so I'm hoping that all of you guys sell it on the open and we can push it down and I can make some money. Just kidding, but if you want to do it, go ahead. But this is a nice pattern setup as is right now. Now, what I want to look at next is the next potential opportunity, right? I can care less about being involved in this as far as analysis goes, right? My analysis is done on this. I'm in the trade. There's nothing else that I can do. As a trader, I'm always thinking about the future. What is the next move? And the next move that I see is a potential structure-based trade. If we can take out this X leg, break and close above. And again, it's a tough visual here because of the gap. But again, just think about this as a candle that opened right here and closed right there, right? So it's not really as structurally intimidating as it seems by having that wick there. But if we can break and close above this, and here goes the IPDE, then, right, if I identify a break and close above that level, I can then make the prediction that price is likely to go higher. Those are the basic rules of structure invalidations. So the next question I want to ask is, if price action is likely to go higher, where are we likely to go higher to? So I've got a few levels that stand out, right? We have all types of inside levels of structure here, but these have been spanked and terminated. They don't really show a lot of respect, right? So we'll aim a little bit higher. And the level that stands out to me higher is going to be starting right here and ending a little bit higher right there. We'll stretch it out, just take that wick into account. Now, I know what you're saying. This is a big zone, so can we isolate that zone a little bit more? Well, I think we can. We have another elephant candle. Where's my emoji? There you go, right here, that big red guy. And again, I want to take the consolidative zone, that green candle, right before that elephant candle, and I can minimize that zone to look like this. And you're going to see that's going to be right around also an even-handled number, which is a psychological number of 158. So I really like that 158 level. Once again, we can pump up the volume on here and drag it from the swing high to the swing low. Whoop, there we go. And you can see the awkward joke I tried to make earlier, right? We have some volume spikes down here. Ooh, I'm interested. We have some big volume spikes up here, including the point of change right at that, well, close to that 158 even handle. It's technically at 158.16, but come on, guys, it's close enough, right? Right at that level. And then in here was our voidable situation that shouldn't be avoidable, invoidable, because we want to get in it if it's in this level. I'm going to stop now. But point is, this gives us confluence that I believe we're likely to travel from said horizontal line there to, right, we can inch this a little bit lower if you want to be, we'll just take the most conservative part of this, to said horizontal line up there. And this is going to be your trading opportunity. So again, how you want to handle that is completely up to you. If you are a breakout trader and you like breakouts, then as soon as this thing breaks out, boom, get yourself involved. If you're a pullback trader, like I mentioned before, wait for the confirmed break, gives you a little bit of confirmation there. Wait for the pullback, gives you a little bit of relief, a cheaper price point to buy, and then look to catch the next extension up to that level. So looking at that on dollar yen, yeah, We are heading over to Bitcoin next, and this was a request that one of you guys put in. If you guys are unfamiliar with the request, what I do is each week I put it out there on different kind of social media platforms, YouTube communities. I put it on Twitter, sometimes Instagram, I tend to forget. But I say, hey guys, Weekend Trading Edge coming out in a few days. If you have anything you want me to take a look at or any questions you want me to answer, any charts you want me to analyze, let me know, because I do want this video to be more so for you guys and not just for me. I do this analysis anyway because that's what I do for a living. But if there's stuff that you want to hear about, stuff that you want to learn, let me know. That way it gives you the most value possible. So I looked over at Bitcoin and I said, man, Bitcoin had a hell of a week as well. We dove down on Bitcoin. And again, this is a lot to do with the new Fed chair nomination and kind of his thoughts on what to do with the Fed balance sheet and how that affects Bitcoin. From a technical perspective, we have a little bit of an interesting situation. Now, it's not nothing I'm personally interested in, but there is an opportunity here. So, first and foremost, Bitcoin is coming to a previous level of structure. If I just kind of draw out my ebbs and flows from down here, I don't know which are ebbs and which are flows, but we'll draw them on. We have this nice little movement that looks like this. By the way, if you guys are new to analyzing a chart and you're new to trying to understand structure and maybe finding yourself struggling with it a little bit, the simple, and this is what we tell all of our traders in the foundation course, right? It's the first course we offer on the course or the second course we offer on the platform. And we say it seems remedial and dumb and a waste of time, but do it. If you just invest time in like just drawing lines on your charts, one, your eyes are going to get very, very used to reading the ebbs and flows of price action, meaning the retracements and the extensions. Two, if you're learning structure, you're going to notice that a lot of these pivots, so the areas where price goes from one direction to the other direction like this, I'll give you a secret. These are where your most important levels of structure are going to be at. So by just drawing these ebbs and flows, you're actually teaching yourself to identify key levels of structure. And if you notice in this situation right here, if I take said line here and draw it out here, we have a nice little structure swap zone where price action found resistance. We broke above resistance. We came back to that same level and we found support, or an ice zone as Peter Brandt calls it, which is much cooler than the way I explain it. So anyway, price is at this ice zone right now, and this is going to offer two opportunities. One, if you're looking for a place to buy Bitcoin, you're a Bitcoin investor, you're seeing this as a little bit of relief, you're looking for a place to buy, I think this is as good of a place as ever. Again, you got to do your due diligence with the fundamental stuff that's going on in the background, but from a technical perspective, this is a solid level. It is a level that has shown to be respected once, twice in the past. Would not surprise me if it's tested again. On the other hand, we also have a head and shoulders-ish pattern. Whether you want to call it a head and shoulders or not, it doesn't ultimately matter too much. But you got to move like this, where you have a left shoulder, a move back down, a head area, a move back down, and a small right shoulder right there, giving us a head and shoulders pattern, which is a classic reversal pattern. Now, in the head and shoulders, there's two ways to look at violation points. There are the lowest low way to do it, the horizontal line, the same line I just drew out. That's how I personally do it. But then there's also the slanted trend line, this dotted line going right here. If you are one that uses the slanted trend line, well, you have a violation of the neckline. Your prediction is now that price is likely to continue lower. If you use the horizontal line, you still have to wait for a break and close. But either way, whenever you get your violation signal, this could allow you to make a prediction lower, maybe into the low of this zone. There's a few things that it looks like we can do to give us some confirmation of that. We can take a 1-to-1 equal measured move from this high right here. I'll make this a different color so we can spot it a little bit better. I don't know if that worked or not, but we'll do it. And we'll drag it on to the pullback right here. And you can see that, boom, that 1-to-1 measured move comes right down at that zone, right about 50K. Yeah, a little bit above 50 or a little bit below 50K right there. We can take our Fibonacci extension tool from that same level, right, that AB equals CD, that swing high to swing low and back down. And we can see if there's any Fibonacci confluence down there as well. Look at that. We have a 1618 Fibonacci extension. So we have a 1618 Fibonacci extension along with an AB equals CD pattern, along with the low of our previous structure support right here. This is going to give us a good prediction point. And the cool thing about this prediction point is that it can be used in many different ways, right? One, if you are a trader that's looking to get short off the head and shoulders or the violation of this level, this is a good level where you can say, hey, if I'm short, this is the area where I want to take targets at and get out of the trade. On the other hand, if you're someone that's looking to buy and say, hey, you know, maybe you missed the buying opportunity at this level, maybe you didn't get your signal for whatever reason, you're saying to yourself, if price action goes down to this level, this is where you expect price to be terminated. This is where you expect the sellers to be taking profit, like I just mentioned, and for less selling pressure to be in the market and more buying pressure to enter the market because, well, this is where it entered the market before, and it is as cheap as ever as a price you can get. This would be the next level where you're looking for your long. So, you know, I say this to traders all the time because a lot of new traders come in and they think that there's bullish analysis, bearish analysis, this analysis, that analysis. There's just technical analysis, right? It just master your ability to make predictions. And if you can master your ability to make predictions, then you can choose which side of the market you want to be on. You can choose if you only want to be bullish, only want to be bearish, but they both complement each other because the target location for the bearish trader is usually going to be a good entry for the bullish trader, and a bullish entry or a good entry for the bullish trader is probably a good place to get out of your trade for the bearish trader, right? So it all goes hand in hand. So trust me when I say just work on that skill of making predictions and you'll become a much better trader. Now, real quick before I leave, my eyes just caught that. We may have one more thing here as well. We may have a Cypher pattern. Let me just get these bad boys off the chart and see if that is something as well. If I take I'll measure out the X to A's later if this is actually a legit one. Let me just see if I measure here and back down. Do we hit a 127? Oh, we do. Okay, so look at this. We actually have a potential Cypher pattern setting up as well down at that level. We're going to look something like this. Look at that. I find new things when doing videos for you guys. Swing low to swing high is our X to A. Our first retracement right here is going to be our A to B. Our extension up here for our C leg needs to hit that 127. Always check your data, but mine's just tickles it, right? Well, it actually crosses through it by a little bit because this is a weekly chart. But you guys get what I'm saying. This is going to be our B to C leg, and then our D completion would be right down here. So another option for you guys, right? You have the bearish option, you have the bullish option, and now you have another bullish option in the form of a potential bullish Cypher pattern with the completion zone going from here all the way to the low of that original zone that we looked at. Yay! Next up is going to be dollar Swiss, and I don't think I had this in my original list, so I promised you 10 opportunities, and you're going to get 11. Haha, take that. But this is a very interesting one on a few different levels, and I don't know where I want to start at. Let's start, we'll start at the smaller level, then we'll work our way up, right? So if we go down to an hourly chart here on the dollar Swiss, we have a potential advanced pattern forming. We have a clear X leg to A leg starting from here to here, right? Our swing high to swing low. I'm going to take my Fibonacci retracement on and drag it from those extremes. You can see that price action comes to a 618. That puts us on alert for a Gartley pattern. And we're looking for the Gartley pattern completion right here at our 127 extension, and that zone goes all the way to our X leg. So that would give us something that looks like this: swing low to swing high, swing high to swing low, X to A to B, B to C, and a CD completion right here for a potential sell. Keep that in the back of your mind someplace, right? The next opportunity is going to be a structure-based opportunity as well, right? So we have our sell zone right here, right? I'll keep that there. The next opportunity is going to be a potential structure-based opportunity. That B leg of our potential Gartley is also a previous level of structure resistance. And if price action can violate that level of resistance, which needs to be slightly adjusted now to these highs, then my expectation is that price is likely to go higher. Where are we likely to go higher to? Well, the same zone that we measured out for the potential Gartley. So this offers one or two opportunities. As we spoke about before, if we get a break and close above structure, then we can look for a pullback and a continuation trade up there. Or you can look for price action to hit that level and have it be a sell. So one would be the continuation trade up to that zone. Two would be the Gartley pattern sell at that zone, or a sell for any other type of reason at that zone. It's a good level of structure regardless of if you're a pattern trader or not. Three would be to do both, right? To buy it here, trade it up to here, and then sell it right away in hopes of coming back down here. And this would become something called a stop and reverse. It is probably the most exciting thing you can do in the market, while at the same time being the most nerve-wracking and frustrating thing you can do in the market. The best one I ever had came a long time ago during my early trading phases during the month of December, and I had 3 patterns in a row where I got into one pattern and then stopped and reversed out at another pattern, and I got directly in another pattern after that, and luckily, I guess, I hit 3 in a row at the end of the year, and boom, done. All right, so I got a little bit distracted. Kid came in. Apparently, they need food to survive, and they asked for some. So I forgot what I was talking about, but I know we were talking about the stop and reverse here. So what the stop and reverse means is like this. So let's say you're entering a position right here. Let's say you're trading a 2-unit position size. Let's just make it simple. You're trading a 1-unit position size, meaning you have 1 contract on. One is whatever you want it to be. It could be 1 mini lot, 1 micro lot, 1 standard lot, whatever your position size is. What you would do is you would buy it up as normally with that 1 unit. And then what you would do up here at the completion point of the pattern is you would sell 2 units. Now you're asking, Akil, if my normal position size is 1 unit, why would I sell 2 units? Well, when you sell 2 units, what that does is one of those units gets you out of your initial trade, so you make profit by selling out of your bullish position. Boom. And then right away, you have a 1-unit position that goes short because that's what you want it to be in for the Gartley pattern. So stop and reverse, essentially you go directly, it's like a U-turn. You go directly from being bullish to being bearish right away. Fun and exciting, but also very frustrating and scary because you're pretty much flipping your position on the fly. It's like you're playing chicken with a truck that's coming straight towards you. Yeah, trading is fun. All right, so now the bigger picture that I want to talk about, let's erase all of this, is if we can violate this same zone that we spoke about, this important level of structure zone, then it looks like we have a lot of room to go higher, right? The next level that stands out to me is going to be right here, the consolidation zone prior to that elephant candle, right? We can also kind of measure out our ebbs and flows. We can see price action comes down here. I'll change that color again because it's too close to the candles. We go up here, we go down here, we go up here, we go down here, right? A nice little shelf was created there. We do have some inside levels of structure here as well, but they're not going to be as important as these recent outside levels of structure. Lastly, what I want to do is I want to bring on my volume tool once again. Bang. And I want to see where the volume spikes are at. What a coincidence, right? The volume spikes are exactly where we drew our zones in. Now, here's something I tell our traders a lot, right? I think the volume tool is a cool tool. It's very, very helpful for getting, it's like a second pair of eyes. It can help you find small detailed differences, but it's not necessary. If volume spikes tend to come at your highest level of interest, your highest levels of interest are going to be your key levels of structure. Therefore, if you can get good at identifying key levels of structure, then you're going to notice that those levels are going to line up, like in this case, exactly where your volume levels are at. So you don't need it. Don't get me wrong, it helps, but I don't feel like you need any type of indicator in trading. Everything kind of reverts back to price. Now again, it is helpful. Sometimes there are levels that you thought would stand out and you bring some volume on, you're like, oh, I guess it didn't. Maybe the market doesn't think it's important. And that's what has helped increase my edge. It's made me a little bit better at stop placement, a little bit better and more precise at target placement, which is how you increase your edge by the smallest of degrees. But it's certainly not necessary. Anyway, going back to what we always talk about, void, deep voice, void. And here, we would expect price action to travel smoothly through the void to the next level of volume. So if price action violates this level, then look for pullback for me personally, and then look for a move back up to this next level. Bada boom, bada bing. So another cool trading opportunity to look at is going to be the Pound Canada right here. And again, just to give you guys some perspective where Pound Canada is at, what has Pound Canada done? Well, one, it has recently broken and closed above previous level of structure. That allows us to make the prediction that price is likely to go higher. If price is likely to go higher, where are we likely to go higher to? We still have a little bit of room right here, right? This thing's been in a little bit of consolidation. It's not really a directional pair recently. I mean, it's drifting to the upside, don't get me wrong, but it's been really choppy and sloppy. But there is room to kind of go across this channel. The interesting thing for me is this, and some of you guys are probably shouting Cypher, so let me just like draw that on for you right away. I don't even know if we have one or not. Yeah, it looks like we have a Cypher here as well. So yes, you may have a Cypher pattern completion as well. This has nothing to do with the opportunity I'm looking at, but if we do go the opposite direction, boom, you got your buy down there. But what I'm looking at is this. I'm looking at price making this high right here, and then giving us some relief or retracement as we would expect. And I'm asking myself, well, if we get some relief, where is relief likely to go to? And going back to my drawing out of the ebbs and the flows, I can draw a little right here. Wait a minute, look. We got a nice level right here. Not only do we have an outside return or retracement here, but we have more of those tweezer bottoms, right? Two candles back to back that have the same lows. For me, it's close enough lows. I don't think anything needs to be in the same, but all depends on if you want to do the dictionary version of it or not, or the practical version. But price has come to this level. It's got rejected twice. Boom, boom. No surprise. You have all these rejections in here. And we've tested that zone with this candle. So going back to the podcast that I did to end the week, Friday's podcast, where we talked about the perfect entry. And we spoke about, I gave a few examples of different entry techniques. And one guy was like, hey, Akil, like I would have, great video, but I would have loved it if you would show more entry techniques in that video, like on the actual charts. And I said, well, usually I do it in the weekend videos, but because it was a podcast, I didn't want the audio only version, people getting like weird and frustrated. But this would be a good example of, finding a zone that you're interested in and then waiting for your entry technique to get involved. So an example of a very aggressive one would be a single candlestick entry. That would be this candle right here. This is going to be a pin bar doji, right? For a true pin bar, we'd love to see a little bit of a stronger close up here near the highs, but this is a candle that has a leg that is longer to the downside than the upside. We close in the upper third of the candle, so it technically is a strong bullish candle with a rejection at the bottom here. So that is good for a bullish sign. Again, I would prefer to see one like, I'm going to see if I can find one, like this is a good bearish pin bar example. See how it has that strong close at the very bottom, and then no surprise we get follow through over there. Let me see if I can find a bullish example for you guys. I'm supposed to be keeping the video short, but then I'm not because I keep looking for more things to teach. And of course, when I look for a bullish one, I'm not going to be able to find a bullish one. That's the curse of the educator, guys. Whenever I try to find something, like I never find it for you guys. Bullish one, bullish one, bullish one. Here's a decent looking one right here, but I'd love to see a really standout one. I'm gonna give it a few more seconds, guys, and then if not, I'll just keep searching and edit it out for you guys, but I do want to look for one. All right, so after venturing for 14 years, not 14 years on your charts, guys, 14 years in real life, I have finally found an example I was looking for. I feel like Matthew McConaughey in Interstellar, where like I come back and I'm so old. And anyway, here goes one right here, right? Long rejection to the downside, strong close at the top, good bullish sign. 14 years of my life just to tell you that when I could have just drawn it out with my box tool. Yeah. Anywho, that is a good example of a single candlestick entry. If you're someone that is less aggressive than just putting the limit order there, but more aggressive than waiting for like a double bottom or something like that. If we go down to the 4-hour chart, oh my gosh, are you serious? There was one right here the whole time. Right here. I am glad I don't have the camera up today, because if you would have seen my face, 14 years, and all I had to do was drop one time frame, which I was going to do anyway. Oh, it's comical. I hope you guys are enjoying this. I hope you guys are enjoying my misery here, because it is a Sunday morning. I am tired. I've been on the road all weekend, and I just spent a significant amount of my life, 14 years, looking for a pin bar when it was right here in front of my face. It's like when I lose my glasses in the house, and I search all around the house, and it's right on the counter where I always leave them. Anyway, a more aggressive entry technique, instead of just the stupid pin bar, would be to look for a candlestick combination, which would be a stupid pin bar and a higher high, higher close next to it right there. I'm done with this pair. Bullish opportunity. If you're interested, nothing more needs to be said. In fact, look at this. Look at this. Pound Canada, you're gone. I'm done with you. All right, next up is Euro New Zealand, right? And Euro New Zealand is a similar situation, but not as frustrating as that stupid Pound Canada. But we have a potential pullback trade. Price action has come back to a previous level of structure right here. We have tested that structure. So far, we have held at this structure. We don't have any bullish signs yet. We do have a doji candle, which is a sign of indecision, meaning the market is having a little bit of a think. And this would be a situation where, again, if we can get some type of candlestick, positive candlestick confirmation, this could be a decent buying opportunity. Now, the level that I would be interested in price going to isn't that great. It's going to be right in this zone right here, and we can kind of isolate that a little bit more and just say 99 even. If we bring some volume in, we should see what? I bet we see a little spike there. Yeah, right around that level, maybe even a little bit lower, 98.50s. So it's not the greatest amount of opportunity in the world here, but there is the chance to travel from here to up there, or even a little bit higher here on the Euro New Zealand. I don't actually know what this pair is doing bigger picture. Actually, it looks like we are... Yeah, actually, we broke structure to the upside here. Probably should have looked at this first on the weekly. So we are in a bullish continuation type of setup. No, we're not. I take that back. Nope, because we have the head and shoulders here. So I take that back. We're not in a greater bullish continuation setup here. So yeah, I wouldn't be looking for any type of extended targets to the high side, but I think a little bit of a move from down here at 197s to 198.5s, 199s is certainly doable. It doesn't look like a lot of space here on daily, but again, this is about 150, 102, 200 pip zone right here. So especially as you go down to the lower time frames, if you can find a legit reason for entry, there is some opportunity on this chart. Next up is going to be the Aussie New Zealand, and this is a very interesting pair because of what's happening in the news. So the Australian dollar has been probably the hottest currency over the last week or so due to their numbers and due to the influence that it has on interest rate hikes. They do have a monetary policy decision coming out Monday night. That's Monday night New York time, so 10:30 New York time. So it may be Tuesday morning, depending on where you're at in the world. But there is a unanimous expectation that a hike is going to happen, right, by a quarter. Now, here's an interesting thing. It's a unanimous expectation, but there have been more and more murmurs that it may not be as much of a done deal as we think it is. And just a kind of a brief talk about news, right? News is scary, but news events don't always cause big reactions. Typically, the market has priced in news events well before they have happened. So like I mentioned, over the last few weeks, the market has priced in an Australian dollar rate hike because that's just how the market operates. So if a rate hike were to occur, the market isn't going to react too much because it's already done so. However, where markets really react is when we have a deviation from the expectation. So when everyone thinks that a rate hike is coming, and if for some reason they said, we changed our mind and we're not going to do it, that's when you would see a massive reaction in the market, or if any type of news comes out that was unexpected. So I don't see them not hiking, but I can see them in the statement coming out and saying something like, hey, we're hiking, but because of blank, blank, blank news that came out, we're not going to do it again, or something like that. And that's going to come in the press conference a little bit later at 11:30 p.m., which is even later my time. Now, also keep in mind, this is a very low liquid time of the market, the Asia session. So not only do deviations from expectations tend to move the markets move quicker when there's less liquidity. So this may even give us a bigger move than normal. With all that being said, if we were to get some type of news that they did not hike, or if we were to get some type of news in the statement that went against hawkishness, right, we could see a big move lower. And if we do see a big move lower, we've got an advanced pattern formation setting up down here in the form of a bat pattern. It is going to look like this. It is going to be a swing low to swing high, X to A. First retracement right here, A to B. This comes to our 50, or it comes past our 50% retracement, which puts us on alert for a bat pattern. For a Gartley pattern, as you guys remember, we need to hit the 618. Now this comes very, very, very close to hitting the 618, but it does not hit the 618. So as I stare at my old computer once again in the rules that are on the back of my wall, I'm looking at it and says Gartley pattern. Does it say must hit the 618 or must come close to 618? Well, it says hit the 618. So for me, it's either black or white. It either hits it or it doesn't hit it. If it does hit it, it's a Gartley. If it doesn't hit it, it's a bat. There's no confusion for me in this. So it's going to be a bat pattern. So our bat pattern comes up here for our C leg, and then the decompletion looks to be starting at our 886 and working all the way down to our X leg. So if price action were to steamroll down off of some kind of reaction to the news, this is a good place to look for buys. I know what you're saying. Why would you want to buy off of crazy bearish news? Well, it's because the market tends to overreact. The market tends to overreact with fear. You can look at the dollar for this as well, or gold or silver. The old saying is what? Bulls take the stairs, bears take the window, right? Where like when you are positive about something, you just slowly accumulate your position. When you are negative, you get out of it as fast as possible, because fear is something that humans aren't good at handling, and we give it more power than it should be. So sometimes you see a big fear-based reaction, the market dives down as everyone panics, and then as the market gives it a think, it's like, you know what, that wasn't as bad as we actually thought, and you start rethinking your position, or bulls in this case start buying because it's really, really, really cheap, and maybe the big picture hasn't really changed. There's also some manipulation involved in there as well, but we won't speak about that. If you do want more on that, there's a great book. One of my trading buddies just picked it up as well and said he loved it. It is called, I need to find it, sorry, A Complete Guide to Volume Price Analysis by Anna Cooling. It teaches about volume, obviously, but it also talks a little bit about the manipulation that happens in the market. So a pretty cool book if you want to understand how the markets actually move from kind of like a, I guess maybe not a fundamental perspective, but like an insider psychology type of perspective, but really good read. Heading from one pattern to another, we're going to go to the Aussie yen. This is actually going to have a double pattern formation on it, and I want to bring it to you because, well, it's a pattern trades are good opportunities, but it also provides a good lesson. So I'll draw this out real quickly since we've done plenty of patterns already, and we don't necessarily need to kind of go through it step by step each and every time. But this is going to be another Gartley pattern, swing low to swing high, X to A. Let me use the one with the letters on it so you guys can see better. Swing low to swing high, X to A. Deep retracement, not touching our 786, giving us an A to B. Deep retracement here, giving us a nice C leg. And then we would look for our decompletion, right? It's the deep Gartley to be in this little zone between the 127 and the X leg right here. So risk reward wise, these are the ones that you're salivating over because you get some really, really good risk rewards in situations like that where it's so deep. So bullish potential bullish Gartley here on Aussie yen 4 hour. If we go down to the hourly, we also have a potential Cypher pattern setting up as well. Again, I'll draw this out the quick way because this is going to be an hour-long video, and I don't know how long your attention span is. The dedicated ones are still with me, and I appreciate you, but the non-dedicated ones have probably left after the first 5 minutes. But we have a Cypher pattern right here, bullish Cypher pattern. Now, the biggest question I always get, Akil, which one do I take? What do I do here? I've got a potential bullish Cypher, bullish Gartley. I've got a potential bullish Cypher. Do I wait for one? Do I take the other? How do I handle this? And this is a simple one. Sometimes there are situations where the market can get cloudy, but this one's pretty simple. Ask yourself this question. Does the small Cypher pattern have anything to do with the bigger Gartley pattern? The answer is no, right? This Cypher can come down here, it can fill, it can close, it can loop-de-loop, it can go up here. Has anything become invalidated with the bigger Gartley pattern? Not at all. So sometimes we just need to put things into perspective. It's very easy to scare ourselves in the market, and that's not unnormal. It's natural. But again, if we're solid in our technical analysis and we understand the potentials of what can happen, what can't happen, what violates a situation, what doesn't violate a situation, it allows us to ignore a lot of the noise that's happening in the market. We do this a lot with reading a trend, right? Where, again, just quick lesson here, where we talk about the market doing something like this and starting to retrace. And I like to break it down into two decision points, right? This is our decision point to the upside. This is our decision point to the downside. Decision point to the upside means that if this level is violated, my expectation is that price is likely to continue bullish, right? I don't have any other expectation until that level is violated. If price were to violate this level, this outside return to the downside, then my expectation is that price is likely to continue bearish. I'm messing myself up here. So if that happens, then we would look for bearish opportunities. Price can do whatever the hell it wants in the middle here, right? It can do this, it can do this, it can go up and down, left, right, sideways, right? Does this affect any of these two predictions? No, right? Because we haven't done anything here. We haven't done anything here. So what I like to do in my personal analysis is I like to identify the key levels, the points that matter, and understand that the market can give us all this junk, because the market, it's like a magician, right? Its job is to give us all these shiny distractions and loud noises and lights and dancing girls and birds flying all over the place. So it distracts us while the magician is actually doing the thing that does the trick, right? I'm that weirdo at magic shows where like I just stare right at the magician's eyes the whole time. Like I don't look at anything because I'm trying to figure out how the trick is done. It gets really, really weird, especially when he stares back, and then I usually just glance down at the ground because I'm ashamed. But the fact of the matter is, we have to ignore all the junk and only focus on the things that are important. Let's head over to the CAD Swiss. This has another head and shoulders potential opportunity on it. Let's first take a look at the big picture. Identify what has price done. Well, price has come to a previous level of structure support, this long wicked zone down here, and we have held, right? We had a big aggressive red candle come down to that level, and then it fully got engulfed the very next day. So we are currently holding at a previous level of structure. This is something that counter trend traders are looking for, proof of hold, to look and enter their potential counter trend trading opportunities, which would mean a bullish opportunity here. As we go down to our 4-hour time frame, we can see that we've put in a potential head and shoulders pattern, which is a classic reversal pattern. And that classic reversal pattern comes at a place in the market, the structure hold, where we would be looking for a reversal. So it's cool how to see those things line up. Our head and shoulders is going to look something like this. We have our initial move down to our left shoulder, our retracement back up, our extension down into that level of support being our head, our retracement back up, and then our right shoulder right here, pretty symmetrical with the left one, and then a move back up to our neckline here. Now, things have shifted a little bit because price hasn't broken out yet, but right now we would need a violation of this level right here, 56.92, in order to get confirmation that price is likely to go higher. Now, the one thing that I'm not a big fan of with this is the potential target location, right? We have a previous zone right here, right? A previous new structure low right here that is going to offer us some inside support. And we can draw up that big zone all the way till here. Now, we don't really have any clear clue of like a big elephant candle for rejection zone in front of it or anything like that. So this is where, again, volume can come into play and letting us know what is the path of least resistance. And you can see big volume spike right here. Our point of change is right at the neckline of the head and shoulders. And again, we're looking for that void, and we can see the void over here. We're getting all excited, but that void only goes to about right here before volume starts to pick up. Now, you do have a much higher level of volume up here. So if you guys are aggressive, you can aim for the very highs of this level, but you can see it's definitely not clear sailing. So one of the questions you have to ask yourself here is, one, where within this zone am I looking for a price action to go to? That's going to be a big dictator of whether this is a tradable opportunity for you or not. And then also, what is your method for taking the trade? Do you trade it on a breakout of our neckline? Because if you do, there may not be, well, if you trade it on a breakout and you're looking for the shorter area of target, there may not be a lot of room in there for you to benefit. However, if you wait for the breakout and the pullback, well, then that can open up a lot of room. So this one is going to be very dynamic based on your personal style of trading, but I did think it was a cool opportunity to share with you. We could bring in some Fibonacci influence. Again, I hear the live room members yelling in my ear. It's funny. So not to make this a live room plug, but I'll end up sharing information about how you can join. But we have our live trading room, and pretty much we trade for a few hours each and every day with a nice community of traders. And I tell the traders all the time that the live room is very important because it gives you reps in the market. And with me personally, I trade the same way. So I come in, we look at different things, don't get me wrong, but as far as my process of trading, I look at the same thing each and every day. I value the same things each and every day. It's not one of those things where it's like, hey, I'm going to go search something on the internet and then like talk about it today and trade that way because that will be the hot topic and I'll get more views and likes. No, like this is about making you a better trader. This isn't about that internet fluff. So I tell traders like, hey, the first week in the live room, you're going to be a little bit overwhelmed because there's a lot of information from all over the training courses and you're probably on course 1 and I'm talking about stuff from course like 10 and you're like, what the hell am I doing? And you get discouraged and I say, just follow the process, give it like a week. And I guarantee like after a week or like 2 weeks, you'll be predicting stuff before I do it because you start to understand the exact process that I follow in the exact same order every single day. So we get in the live room, we analyze stuff like this. I'm like, okay, guys, let's see if we can narrow down those targets. What should I do? And I look to the left and people are always like, already, throw volume in there, throw fibs on there. What about that? And I'm like, you guys know me better than even I know myself. So again, it seems overwhelming, but I'm hearing you guys in my ears right now saying, okay, Keel, bring a Fibonacci on. So guess what we'll do? Let's bring a Fibonacci on. Let's bring a Fibonacci retracement on from this swing high to this swing low. Oh yeah, I forgot to tell you how to join. www.tier1trading.com. That's our website, 14-day trial membership. It gives you access to New York live room, London live room, some courses, community, fun stuff. Go there, have fun. Yeah, no risk-free, no auto bill plugs, right? Do we have any Fibonacci influence here? Well, we got a 618, a little bit lower in the zone. 786 up here at the top. Let's bring a Fibonacci extension on, see if there's anything in here. Swing low to swing high, so the head to the right neckline. And see if there's any confluence there. We have a 127 here, yeah, so there's not really too much. The 127 and the 1618 would mean more to me than this 618 because it's in that structure zone. But it doesn't really tell us anything different than we already know. We already have this zone marked out. This is pretty much the zone that we had marked out anyway. So unfortunately, it's not going to help us with this one, but still a cool trading opportunity to look at. All right, we are inching towards the end here, guys. Got a few more to look at, but I also have that lesson I want to share with you, so I really appreciate you hanging with us. Pound dollar, we'll make this quick. Another advanced pattern formation. Swing low to swing high is going to be our X2A. I'll measure this out. This is going to be a bat pattern. Swing low to swing high, X to A to B right here. Deepest retracement is going to be our C leg. And then our D completion is going to be right here at our 886. Why did I look at this as being my B leg versus this as being my B leg right here? Well, it has to do with the deepest retracement. Because C is our deepest retracement, that means that this must be my B. If price action did a thing where it came up deeper than C right here, then you can make the adjustment right there. But nice bat pattern at market, pound, dollar, hourly, also viewable on the 4-hour. There you go. Lastly, the Dixie, the dollar index is going to be very similar here. We have an advanced pattern formation. swing high to swing low. You can see right there, price action clearly spikes past our 618 Fibonacci retracement, which puts us on alert for a Gartley pattern. So we're looking once again at an X to A, an A to B, a B to C right here, and then a CD completion, a deep one, right at where price action is currently trading, with that zone going to the high. Very similar to dollar Swiss, and you'll notice lots of similarities between the dollar index and dollar Swiss and the dollar index and euro dollar. Well, pretty much like this. The dollar index is pretty much the reciprocal of the euro dollar, and the euro dollar is pretty much the reciprocal of the dollar Swiss. So they kind of all look the same. Let me show you a chart here real quick. Let's go here and let's make this a line chart just to make things easy. So this is the euro dollar right here on the daily. If I were to add the Dixie, the dollar index, and not do it percentage wise, you're going to see that the dollar index, look at that. Euro dollar goes up, dollar index goes down, right? It's pretty much right, the exact same, just flipped upside down. If I were to add one more and make things confusing, let's add the dollar Swiss. By the way, this is a great, if you're ever looking for, I promise I won't get on a rant about correlations, but if you ever are looking for correlations in the market, an easy way to understand it is draw on a line chart like this, and it gives you a nice visual. So you can see dollar index is in blue, dollar Swiss is in green. You see what I'm talking about? You see what I'm saying, right? They're pretty much the exact same thing. If we were to flip the euro dollar upside down, it would be the exact same thing as well. I wonder if I can actually do that. What if I do dollar euro? Oh, let's see. Oh, look at that. It's exactly the same. Yeah, I don't remember what the point of this was, but to tell you that it was the same opportunity as dollar Swiss, right? Cool trading nerd stuff. So if we can violate these highs, we can expect that price is likely to continue up to this level right here. So there's a big whopping zone. Sorry, let's try it again with my right thing. There's a big whopping zone of potential here on the dollar index if we can violate this level. Now, lastly, as promised to you guys, because I am a man of my word, I had a question come in this weekend and I want to answer it. James said, I am backtesting channels at the moment, seeing if I can figure out a tradable strategy. Any thoughts on how to create and backtest a channel strategy would be very helpful. Well, hard question to answer because we need more information. But it first starts off by asking you the question of what type of channel are you trading? There are two main types of channels. There are going to be horizontal channels. These are going to be your channels that just channel sideways. So they kind of go up and down, right? Your accumulation and your distribution zones for you guys that are familiar with Dow theory and Wyckoff cycles. Or there are going to be your sloping channels, right? So these are going to be a downward channel, something like this, or an upward channel, something like this. So each of these channels gives different information. With your sloping channels, these are typically looked at as being deceleration patterns. So price action has come from a steep slope, like a big bearish move here, and then the slope grade started to decrease, and pretty much the market is losing steam. So off of this channel right here, which we would call a falling channel, we would expect a bullish reaction. The exact opposite would be from a rising channel like that, we would expect a bearish reaction. So in these two channels, there's a clear directional bias of which way you want to trade. I would only be looking to trade long on these. I would only be looking to trade short on these. With the horizontal channel, aside from any type of technical clue in a higher time frame, these are more neutral. These are kind of like triangle patterns or kind of regular triangle patterns where I have no idea if price is likely to go up or down. So there's two ways to trade these. One, you can trade support and resistance from side to side, meaning you could be a trader that after a certain amount of touches, you like to buy at the low and then sell at the high, and then maybe sell again at the high, and then buy and make profit at the lows. You can just trade the channel bounce back and forth. Or you can trade the breakout from the channel. This is what I personally like to do, where going back to that lesson I gave you on like decision points, the areas that I care about are going to be here, and nothing else in the middle matters. But if we get a break and close above this level, then I am predicting a bullish continuation. If we get a break and close below this level, then I am predicting a bearish continuation. So what I'm doing is I'm waiting for confirmation of the violation. I'm waiting for the market to tell me which way it's more likely to go, and then I'm looking to get directionally involved in that direction. So yeah, as far as your back testing, we can't even get into that yet, because before you can back test anything, you need rules, and before you need rules, you need a hypothesis. So your hypothesis is essentially your theory, where it's like, if I see falling channel, then I expect price to rise. If I see rising channel, then I expect price to fall. If I see horizontal channel, then I expect price to bounce off trend lines, or I wait for break, whatever your method is. Once you have that, then you need to create a clear rule set for that. So the hypothesis is your theory. What are you recognizing, and what do you think is going to happen based off what you recognize? 2 is going to be creating your rules. Okay, based off of your theory, what rules can I put in to attack that? Again, a good example would be, if price action breaks and closes above trend line, then look for pullback into previous level. If I get pullback, then look for higher high, higher close candle for entry, and then stops and targets, all that jazz. Once you have those rules, then step 3 is to go into back testing and test those rules. So right now the trader is asking about step 3, but before we know that, I would need to know step 2, and before he can even create step 2, he would need to know step 1. So I can't fully answer the question about how can you back test the channel strategy until I know what the channel strategy is, but hopefully this gives you some ideas on what methods you can, or what paths you can take. So this is stuff that we do in our Monday Q&A session each and every week on the Tier 1 trading platform, where we work with traders on developing a strategy, where they come in with a hypothesis. We help them kind of branch out those ideas. We help them develop rules, and then we pick apart their rules to make sure there's no gray area. We do that each and every Monday with a small group of traders. If that's something you're interested in doing, or if you're just interested in becoming a consistently profitable trader, check us out, www.tier1trading.com. We've been coaching traders for decades now. We do a really, really good job of doing that. So if you're serious about your trading education, if you want real stuff that works and not the internet fluff stuff, give us a try. www.tier1trading.com. As always, I recommend starting with the 14-day risk-free trial membership. That way you can make sure that our method of teaching and our content is what's up your alley before making any type of financial commitment. All right, thank you guys for watching the video. Like, subscribe, look out for cool videos coming this week. And until next time, plan your trade, trade your plan. Take care.
I wanna be the best in the game, invest in my name, check no restraints, I'm obsessed with the pain. I ingest, I retain, assess and I change, possessed by the thought I'll be free one day from society's restraints, money, clout and fame, mud, disease, a plague. We all love to hate, have to play the game, have to make a name, all our insecurities are on. This is